Imagine maxing out your credit cards, then turning around and lending yourself money to pay them off. It sounds insane, the kind of financial logic that would bankrupt most of us in months. Yet this is exactly how the United States government finances itself. The government borrows money by issuing bonds. Then those bonds are bought by its own central bank. On paper, it looks like America is paying itself with money it doesn't really have. In reality, this is the biggest financial trick in the world, and it's the foundation of the modern global economy. The real question isn't whether this trick is clever. It's how long it can last before the illusion cracks. Let's start simple. A government bond is just an IOU. When the U.S. Treasury issues a bond, it's saying, "Lend me money today, and I'll pay you back later with interest." Treasuries are considered the safest investment on earth. They're backed by the full faith and credit of the United States. For more than 2 centuries, that faith has been strong enough to let America run deficits year after year, spending more than it collects in taxes, confident that someone will always buy its debt. This goes all the way back to the birth of the country. After the Revolutionary War, the young United States was drowning in unpaid debts. Soldiers, suppliers, even foreign allies like France were owed money. Alexander Hamilton, the first Treasury Secretary, understood something crucial. If the government honored its debts, investors would keep lending. So new bonds were issued, old debts were paid, trust was built. But at the same time, a cycle began. Borrowing, rolling over old debt, issuing new debt. Bonds became the lifeblood of American finance. The real transformation came in 1913 with the creation of the Federal Reserve. Before that, the U.S. banking system was unstable and prone to panics. The Fed was created to stabilize it, but over time, it became something else. The silent partner of government debt. During World War II, the Treasury needed enormous amounts of money. The Federal Reserve stepped in and agreed to buy government bonds whenever necessary to keep interest rates low. In effect, America had guaranteed demand for its own debt. The Fed could simply create money and use it to buy treasuries. Then came 1971. Until that point, the dollar was tied to gold. Foreign governments could theoretically exchange dollars for gold, but war spending and growing deficits strained the system. So President Nixon ended the gold standard. From that moment on, the dollar was backed by nothing tangible, only trust. And that trust rested on one thing: the world's willingness to keep buying U.S. debt. So how does the system work today? The U.S. government spends more than it collects in taxes. To cover the gap, the Treasury issues bonds. Those bonds are bought by banks, pension funds, insurance companies, and foreign governments. But when demand weakens, the most powerful buyer steps in: the Federal Reserve. The Fed doesn't need savings or tax revenue. It creates money digitally. Numbers are typed into existence, and treasuries are purchased. New money enters the system. This isn't theory. After the 2008 financial crisis, the Fed bought trillions of dollars in bonds. During the pandemic, it did the same on an even larger scale. In practice, the United States was buying its own debt. To most people, this sounds absurd. How can a country borrow from itself? How can money created from nothing be called wealth? Yet this is the core of the modern financial system. It's how wars are funded without raising taxes, how stimulus checks appear, how financial bailouts are paid for when everything is collapsing. But every illusion has a cost. And that cost isn't paid by Washington or Wall Street. It's paid by you, through inflation. Every time the Fed creates money to buy bonds, existing money loses value. Prices rise, savings erode, wages fall behind. Inflation is the hidden tax that makes this system possible. There's another danger: dependency. U.S. debt has passed $30 trillion and keeps growing. Foreign buyers like China and Japan are slowly reducing their holdings. That means America relies more and more on its own central bank. More money creation, more inflation pressure, more fragility. History has seen this before. Britain financed its empire with debt until trust collapsed. France drowned in obligations before revolution swept it away. Debt can fuel empires, but trust is what keeps them alive. America still survives because the dollar is the world's reserve currency. Oil is priced in dollars. Global trade runs on dollars. But cracks are forming. Countries are stockpiling gold. Alternatives are being discussed. If the world ever decides U.S. debt is no longer safe, this trick could unravel fast. And this is why it matters to you. This isn't abstract economics. It's your grocery bill, your rent, your savings, your future. Empires rise on debt. They survive on trust. And when trust fades, the public pays the price. If this story gave you a new way to look at the world, subscribe to the channel. History doesn't just tell us what happened. It shows us what we can't afford to ignore.